So, is it time to worry? I actually do think that it's time to worry a little bit. A little bit of worry all the time is probably a good thing. That seems a little bit contradictory in terms of what we try to do in this channel, which is to try to give you peace of mind through sound planning. And so I'd argue that most of the time we want to be in that peace of mind zone. But from time to time, there can be things we begin to see that heighten our concern, that might lead to worry. And if that worry leads to action, particularly as it relates to action in our retirement income plans and how we handle those plans, then I think the worry could be good. So I'm going to talk about why I'm a little bit worried and what kinds of actions we should be taking as a result of that, both in terms of our retirement income planning as well as our retirement portfolios. So I'm going to connect the dots between worry and action and share some strategies that I think you need to be focused in on as it relates to your retirement going forward over the next couple of years, maybe longer. So let's first of all just talk about kind of the background to this video. I'm in a very fortunate position. I've been doing this for 3 decades, 30 plus years. And so I've been seeing patterns. There's pattern recognition that takes place both in the long term as well as in the short term. Longer term, because I've worked with hundreds of families getting ready for retirement, helping them to transition into retirement and be retired, again, there's success patterns. There's things that you need to be doing. And sometimes those patterns and strategies may not be the theoretically best way of doing things, but in the real world, they're the best. Because the interesting thing about planning and what you see often is these very clinical strategies, even retirement income plans, you spend a lot of time dialing in the numbers, but those discussions more often than not don't take into account human nature. Yes, we need to use analytics and computer modeling and forecasting and strategies for retirement. That's all good stuff. But often we don't have great conversations about human nature and how emotion and psychology can get in the way of effective planning. You can have the best plan in the world, but if you don't have guardrails in place to keep you from letting human nature get in the way, you can run into a lot of problems. Okay, so over the last 30 years, we've learned a few things. I'll share with you some strategies that can be very helpful in that regard. The second thing, over the course of every week, month, quarter, and year, I have a lot of conversations. And you begin to see some things emerging. So I'm going to share with you 3 emerging themes. I'll call it kind of the investor zeitgeist, which usually refers to one overarching theme. But I'm going to talk about 3 kinds of conversations I'm having with people. And those 3 kinds of conversations can lead to problems. And I've seen it in the past, and there's a potential it could lead to problems in the future for you or other retirees that are planning their retirement, maybe in retirement or just getting close to making that transition. So over the last 3 decades, you tend to see them oscillating and becoming stronger from time to time. And when I look back at my own career, that's when you need to sort of sit back and go, okay, are there some lessons we can apply right now? What are these main themes telling us as people thinking about retiring, getting our portfolios ready for retirement, or maybe you're already retired? So the first theme is individuals, not always, but often do-it-yourself investors who, rightly so, are very pleased with the performance in their portfolios the last 5 years. Markets have been pretty strong. They've participated in that growth, and that's all good. So it's not a criticism. However, what can happen sometimes is we begin to confuse the performance of the portfolio with our wisdom, intuition, and our investor ability, when in fact maybe a lot of the performance just happened to be luck and timing, and your input to that success may not have been a significant contributor. Now that's maybe not an easy thing to hear, but that can often be the reality. And if you look back on markets and historically how retail investors have behaved, sometimes that happens, right? And it leads to a little bit of overconfidence. I wouldn't call it hubris. I think that's too strong, but a little bit of overconfidence that they can sort of read the economic and market tea leaves and make good, smart decisions about their portfolio. And what I would say is I don't think the data bears that out. Where people get in a lot of trouble is when they were kind of riding the momentum of markets driven by other things and took responsibility for that success. Well, I hope you're enjoying the video. If you're beginning to think seriously about your own retirement income planning, be sure to go to the show notes. There's a link back to our homepage where you can find out how you can get your own customized retirement income plan or complimentary gap analysis. As well, if you go to the bottom of our homepage, you'll be able to find a section where you can get hold of a free retirement planning resource bundle chock full of videos and PDF documents that help you plan for a great retirement. Now, you may have made some great decisions on your portfolio. And I'm not saying you shouldn't be managing your own portfolio, not that at all. But you do need to inject a little bit of humility into your planning to say, okay, are there some blind spots? Are there things that I can learn here in terms of how I'm handling my portfolio? So it's kind of like a little bit of overconfidence. Just be aware of it. That can lead to some problems. And we'll talk about how to handle that in a few minutes on the strategy section. The next group is a group that has humility. They're not taking full responsibility for the success of their portfolios, but they're kind of in a situation where they're just complacent. They probably know at some level they probably need to make some adjustments, but boy, the portfolio is done well. They're reluctant to downshift some of the assets into more conservative holdings. Doesn't really appeal to them. They don't have a sense of urgency around making those changes. And again, that can create some problems. I'll tell you just a story. I used to work on Portage and Main in what was called the Trizac building at the time. On the 27th floor, we had our offices there. And on the same floor was a technology company called Nortel. And some of you may remember that name. And Nortel at the time was a high-flying stock doing extremely well, fiber optics, networks, cables, that kind of thing. And I'd ride up and down the elevators with these individuals. They had smiles like Cheshire cats, very happy with the performance of their share price, and never thought that that company would do any wrong. And in the end, the story was not a good one. The company went bankrupt. Those people I rode the elevators with lost their share value, significant share value, and they never did go in prior to that correction on that stock to consolidate some of those profits. And one of the reasons was they didn't want to pay the tax on the capital gains, so they just didn't do anything. So that complacency really hurt them. And so that's a dramatic example, but investor complacency can hurt retirees. And there needs to be a disciplined process to fight against that complacency. And we'll talk about that in the strategy section of this video. And then the third group are the group that actually hasn't participated in this market in any meaningful way. Very bearish. They're reading the economic tea leaves. They're subscribing to investor newsletters, blogs, and there's all kinds of reasons to look at the economic data, the debt situation of countries, and the turmoil around the world, and to be bearish and not to participate in capital markets. But again, that can lead to some problems, whereas we try to time our entry point to markets because we're so bearish we haven't done it. There's a huge opportunity cost there. And there certainly has been an opportunity cost for some investors because of that. Now, you may not feel like you've in any of those three camps, or maybe you're kind of a mix of those three camps. But what I'm going to do is I'm going to go through what the implication of that is. What happens to people that fall into those camps in terms of performance? And the reason I want to show you these numbers is that most people intellectually will never believe that they will, as individuals, succumb to these patterns that I'm going to show you here in terms of underperformance on portfolios over time, because you just feel you're resilient and you can defend yourself against what I talked about earlier, which was human nature, getting in the way of performance. But I'm going to argue that most of us do succumb to the human nature that can derail performance. And like I said, we need to have guardrails in place to protect us from ourselves. That's really the basic point here. So let's look at some interesting statistics to kind of frame the discussion. Again, you might feel that you're smarter and you're more disciplined than the average bear, and you will not be one of these statistics. But it's important to look at these stats and then just be a little bit self-reflective and go, okay, could this apply to me? And maybe I need to be proactive in my approach to putting guardrails in place. So like I said, I actually wrote this little comment down, and this isn't a quote from someone. I wrote this. So great retirement plans can be created, right? But it's discipline that makes them actuated or acted on and successful. And that accounting for human nature is critical in the process. I'm going to share with you just a crazy statistic. So some of you may be familiar with the name Peter Lynch. Peter Lynch was managing the Magellan Fund with Fidelity Investments in the U.S. from 1977 to 1990. And over that 13-year tenure, Peter Lynch was managing the global balance fund called the Magellan Fund. And that return, believe it or not, had a 29% compound annualized return over that time period. It was absolutely just mind-blowing. And over that years, of course, it had massive inflows, fund flows to the mutual fund because of its performance. And after the fact, Fidelity actually did some research, and they were trying to figure out what was the average performance of investors who bought into the Magellan Fund during Peter Lynch's tenure at that time. And what they found out absolutely shocked them. What they found out is that the average performance of investors who purchased the Magellan Fund over that time period, between 1977 and 1990, actually lost money. So you got this completely crazy stat, 29% compound annualized returns, and the average investor who bought that particular portfolio lost money. Now, what was the key psychological driver that was, making those people take actions that actually had them lose money in that portfolio? And what they said in the study was these investors were chasing returns. And so they were not acting with discipline. They were using the shiny object of performance to guide their investment behavior. And when that performance wasn't there, they wanted to fix it. So they sold, obviously, at the wrong time to try to fix the problem, and they weren't acting with any amount of discipline. Now, whether or not somebody had the conversation with them on this, I'm not sure. But the Magellan Fund, to drive a 29% compound annualized return, it was a very aggressive fund. I mean, one book that Peter Lynch wrote, I can't remember the name of it, but he talked about the 10-bagger approach to investing. So you buy 10 stocks. All you need is one stock to just hit a home run, and overall performance could be very good. I'm not sure whether he applied that logic to the Magellan Fund, but it was an aggressive fund with a huge swing rate in terms of year-by-year volatility. So even though the long-term performance was great, if you were kind of trying to time that and you were chasing returns, then it could really hurt you. So there's two characteristics that investors take, and we really haven't hit true volatility, which I'll talk about in a minute, some of my experiences that maybe you could learn from. But we chase return. I mean, that's a psychological trait when we're making investment decisions. And then when our investments don't do well, we want to fix the problem, right? When we have problems in other areas of life, then we develop our action plan, we act on that plan, and we drive towards fixing that problem, right? That's just a natural impulse. Ironically, when it comes to investments, that could be sometimes the worst decision that you make. If you combine chasing returns and then wanting to fix the problem through action when your performance isn't very good, that actually could hurt you even worse, right? Sometimes the best decision, if you're holding high quality investments, is to hold those positions and to be patient, providing they're high quality, not fixing it by unloading and trying something else to try to fix the problem, which is what investors more often than not will do, particularly during turbulent economic and market periods. Let's move from the Peter Lynch discussion to take a look at more of a broad discussion on investor behavior in aggregate. So what you're seeing on the screen is some information put together by the Investment Funds Institute of Canada. Now, this is data, it's older data, but it's data going back to 1992 through 2011. And they were just basically looking at the average performance of Canadian equity funds during that time period. And what they found was the average performance on Canadian equity funds between 1992 and 2011 was 8.2% per year. That's the left-hand column. And the right side, they looked at the actual performance of investors buying those Canadian equity mutual funds, and their performance was 3.5% compound annualized. So huge difference in performance. The researchers referred to that as the investor behavior penalty. This gets back to what I just talked about with Peter Lynch. People are chasing returns, and they're trying to fix a problem by trading out of their positions and trying to find something else, probably using chasing the return idea to try to fix a problem. So again, the long-term stats tend to confirm this is a generalized trend. The next chart that you'll see on your screen is from JP Morgan, looking at data over the period 1994 through to 2013. And what you see from left to right are the performance numbers of all the major asset classes. You're going through REITs, oil, S&P 500, the EFA index, stock index, gold, bonds, real estate, and inflation. And you can see that the long-term performance against all those asset classes for the average investor was 2.5% per year. Inflation averaged 2.4%. So what is driving that? So I've talked about two things. Again, chasing returns, and then the other one was this idea of trying to fix a problem. Okay, now let me just show you another chart, and this is going to frame the discussion. Really, this is the whole nub of the issue, and what you see on the screen is just some data. And I entered the industry in the late 80s. So basically, I was working at Royal Trust in 1987. And at the time, Royal Trust was one of the largest retail financial firms selling mutual funds. I think the only other firm that was as big at the time was Investors Group. So we had a lot of fairly unsophisticated investors buying mutual funds for the first time. Keep in mind, that was a time when GIC rates were pretty consistently, 6, 7, 8% per year. But we had gone through a period of time where performance on mutual funds had been very, very good. So people would walk into the branch and they'd see these performance number posters and they want to buy some of that stuff, right? They were chasing return. That 6% per year from their GICs looks very low. Let's get something that really jazzes up performance. So they start buying equity mutual funds. And you can see the first highlighted line was in 87, and the markets basically over a few days corrected 33%. We were down 33%. And it took about 101 days, that's the far right column, for the markets to recoup all of their lost value, but they did recoup it. And in fact, by the time we got to the end of that year, the markets had pretty much rebounded. But it was a very, very volatile time in the markets, and retail investors were just like running for the hills. So we had all kinds of people running into the branch, wanting to sell their mutual funds. They weren't my client. I worked for Royal Trust, but they could do what they wanted to do. I wasn't standing in the way of them selling and triggering a 30% loss and then buying a GIC getting 6%. Clearly, they would never really recover from that financial decision. And we've seen this pattern repeat itself time and time again. If you look at the next one is 2000, the tech wreck. There is a lot of parallel to today's situation for investors, whereas we saw a tremendous amount of self-directed activity, people buying technology stocks. It was just the Wild West. And for us at the time, taking a more balanced, conservative approach to investing, we were so out of favor with that style. And yet, of course, the market corrected violently. It was down 49%. And there was a good lesson there. People were buying the tech stocks, again, using it, through the lens of my ability, my intuition. Aren't I smart? Buying the securities, riding them up. And then they didn't know at what point to take profits or exit the markets, and they got caught. And they went through, huge volatility. And we probably lost investors to the market forever, some investors, because of that volatility. And if you look at the next great period and highlighted there is near the end of 2007 and then 2008 great financial crisis. Like I said, we had clients that retired in 2007. None of those clients unretired. And I'm going to talk about the guardrails that we put in place back then that ended up protecting clients and their portfolios from what was a pretty significant downturn. I mean, we saw the S&P 500 drop 56% at its worst. So the question I want to ask you when you take a look at these numbers, these minus 33, minus 49, minus 56, those are outlier black swan years. There's no doubt about that. But they can happen. So the question is, do you have guardrails in your portfolio to deal with that? And how will you deal with that? Like if you actually experience that kind of decline in part of your portfolio, what would your response be? Now, one of the correct responses is when there's bargains in the market, and we've all heard this, right? So when there's bargains in the market, it's like any other sale. You buy when the bargains are manifesting themselves, and you get a little bit concerned when the assets you bought are now getting a little bit pricey and expensive, right? That's just a truism, and we try to apply it, right? But how many people actually do apply it? Because human nature is that when our portfolio is doing really well, we fall in love with the winners and we fall out of love with what we perceive in that moment as losers. And psychologically and emotionally, that keeps us from acting with discipline. One final comment on this. So I'm a part owner in our branch. We have 30 advisors in our branch. We manage a significant amount of wealth for the families that deal with us. And if I look back at the last 30 years, and I'm not the only advisor in this situation, what percentage of investors, when we hit minus 33 or minus 49 or minus 56, even the minus 19s that show up there in that chart, how many people were running into our branch, into our offices with checks, wanting to buy back into the market? Not a lot. Very, very, very small percentage of people were acting in that fashion. Human nature. And that's why putting in place guardrails, which we'll talk about right now, is so important. Now, the last slide that I want to show you before we get into the strategy guardrail discussion is a chart looking at the S&P 500 from 1988 to 2019. Roughly we'll say about 7,000 trading days. And what you're seeing on that chart is the daily swing of the market every single day over that time period. Now, do you see a consistent pattern there? Often what we see from financial institutions are these mountain charts, which I'll show you in a second. And the mountain charts show you the consistent upward uptick, let's say, of a bull market cycle. But what they don't show you is the daily fluctuation. So they just show you the incremental accumulation of value based on the positive days. So roughly, the market's up about 75% of the time, down 25% of the time. But this shows you the daily fluctuation. You can see that there is no clear pattern that's emerging here. The good days and the bad days are stacked up right against each other. So if you were sitting looking at the daily news trying to figure out what action you're going to take, that is one very, very difficult decision to make, right? The reason that it is almost impossible to time the market, right, is because of this. There's so much noise out there every single day. How in the world are you going to be able to time your investment decisions? So like I said, sometimes when you see outperformance, it's not because of our intuitive, natural ability or wisdom around capital markets. It's because our timing was good. And maybe we held some investments, fortunately, that were able to ride that momentum. And this chart clearly demonstrates this huge amount of daily noise that's very difficult to predict. But the other really critical piece of this chart is the fact that the 20 best days and the 20 worst days, the worst are in the red here and the best are in the green, are stacked up right up against each other. So a lot of investors think that patterns begin to emerge as it relates to the markets, this incremental improvement over time, and that will allow me to pick my entry point or my exit point. That's just not the case. So volatility, chaos, noise are all bunched up in amongst each other, and it's almost impossible, if not impossible, to read the economic tea leaves to make the right investment decisions in that moment. So if we have to fight against human nature, if we have to fight against the natural noise of the markets and the fact that we live in a complex world where it makes it impossible to time the market, what in the world are retirees to do with their portfolios to navigate through this uncertainty? Okay, so worry is a good thing, a little bit of worry, and it's my hope that a little bit of worry in this presentation will then move you to take a look at these strategies. Let's look at them right now. Now, the first thing we're going to do before we get into the guardrail discussion is take a look at the historical bull and bear market cycles, and we're going to use the U.S. market as an example. This is the S&P 500. So the image on your screen, the dark blue are the bull market cycles, the light blue are the bear markets, and you can see that on average, obviously the bull markets are much greater and much longer, than the bear markets, which are less decline and shorter. But the bear markets in the light blue give us some patterns that we should be using to construct a retirement income portfolios, particularly given that will be, for most of you, you're probably going to be taking money out to supplement other sources of income. So, sometimes it's a 20-month period for recovery, 6-month period, 30-month period. But what we say to clients, and we'll talk about the timeline investment strategy, you want to have at a minimum 2 years worth of cash wedge assets to protect you against bear market cycles. And ideally, we think at least 3 to 4 years would be ideal. Now, not every retiree can afford to do that. That might put too much pressure on their portfolio where they're not getting the performance numbers they need if they have that much cash in their portfolios. But the first principle is, try to line up your guardrail to anticipate that it could take 20 months to 25 months for the stock side of your portfolio to recover, and you need to sort of build in some safety mechanisms to be able to wait that long for the recovery to take place. So if I had to sort of strategize the different things that we need to be putting in place in portfolios, I'll just kind of give you a bit of a laundry list. Number one, do not take on more financial risk than is required to fund your retirement income plan. It didn't matter as much leading up to retirement. You were in the accumulation phase. But as you transition into the deaccumulation phase, managing downside risk is critical. Take on sufficient risk to drive the returns necessary, but no more. Secondly, resist the urge to time the market. There's too much noise for you to be able to do that. You can't do that successfully. And when you do it, it's probably because of luck, if it worked out for you. So do not try to time the market. Buy, hold, clip, or rebalance. So you shouldn't need to be making a lot of changes to your portfolio over time, but you definitely want to have the discipline to clip profits along the way when they emerge. So that's a big shift. In retirement, you just don't let your assets compound and compound. For many of you, you're going to need to go in when there's excess performance, like we've had the last little while. Go into the portfolio and clip those profits and protect them, whether it's in high yield savings, GICs, or short duration bond portfolios. Try to buy on the dips. The dips are going to come. That's guaranteed. And your solution to that should not be chasing return or trying to fix the problem. If you've got high quality investments in your portfolio, buy more of them on the dips. Not sell them, or not just sort of stay on the sidelines. Now, one of the easy ways of doing that is you can buy investments that systematically rebalance. Whenever there's fluctuations, if you had an ETF portfolio, Vanguard has a great one where they'll rebalance between fixed income and equities systematically for you, right? So you don't have to sort of physically make a change or write out a check and add to your portfolio. So the more automatic it is, the more likely it's going to happen. Go back to my example, being a branch owner of a very large branch with my partners, we do not see lots of people running into the branch, adding to their portfolios in a down market. But we do see people who have systematic rebalancing in place, allowing that rebalancing to happen, right? So make sure that you've got a rebalancing strategy in place and that you're finding a way to buy into the dips. Next, you want to make sure you're using a timeline 3-bucket approach to your portfolio planning. It can be argued theoretically that you don't need to do that you just keep cash and then equities. But my experience the last 3 decades is that is not consistent with most people's psychological and emotional frame. It just exposes them to too much risk. Theoretically, it could work. Practically, it doesn't in the real world. And even if you don't need income from your portfolio in retirement, even pre-retirement, clipping profits when there's profits on the table can make sense. It's just raising what often people call dry powder. You've got money in your portfolio. In retirement, you may not be adding new money to your portfolio, but you can use those profits to clip them, put them to the side in safe harbor. That dry powder can be used to reinvest back into the market. And then the last point I would make is do not use rules of thumb to make decisions on your portfolio design. Get a plan in place. Now, whether that's you developing your own Excel spreadsheets and doing the analysis, or whether you hire someone a retirement income planning specialist to do it for you. Rules of thumb are a starting point, but that's not how you put in place a retirement income plan. There's lots of really good modeling software that just pulls all the pieces together for you. So again, go to the show notes for this video. There's a link back to our website where you can find out how you can get your own customized plan. So the next image is the timeline. So again, there's 3 main timelines. So your retirement income plan is going to define these for you. The first timeline on the left is the income wedge or cash assets that need to be in place to fund at least 3 years worth of income. The middle timeline are slightly more defensive positions, but you're in the markets. You're trying to get a little bit better return, obviously, than cash equivalents. And then you have part of your portfolio that you don't need. That's the far right-hand part of the timeline. You don't need that for 8, 9, 10 years. And there you want to be in low-cost indexing, ETFs as an example, and just trying to grow your portfolio as much as possible over that timeline. So those are the strategies. Again, you need to be self-aware. You need just to reflect a little bit. Take a look at those 3 profiles that I've been talking about that kind of emerge in my discussions with people, and then use these strategies as a way of dealing with the uncertainty of the world and try to increase the probability of success in your own retirement income planning. If you like this video, click on the next video that's showing up on your screen. I'm sure you'll enjoy that as well. You take care.